Hi, everyone. Welcome to our biweekly webinar. I'm Dr. Fasanya, Dr. BDZ Capital. Sometimes I introduce myself as Dr. BDZ. It's like one and synonymous with each other at this point. We're bringing in Josh Harmon again. Last time he talked to us about how to find a great deal in this current climate, which we understand that it's very difficult to make anything work based on the high interest environment, and also sellers they're not capitulating yet. Maybe they're getting there, but so you have a situation where sellers want to sell high, and then the interest rate will not let the buyer cash flow. So that was a very awesome session. So now he's coming back to talk about asset management. So he's been helping us with doing asset management together. He started off as acquisition mostly, but he's starting to love asset management also. And he does have his own properties. He has, last time I remember, it was so close to 300 units of his own. And then he joined us, and we have about 883 units. As a team, we have over 1,000 units. So yeah, he has a lot of value to give. I'm glad to have him, both as a member of the team and also for coming here today. Josh, yep, I'll let you go.
What did I do to deserve that type of bio, brother? I appreciate it. I appreciate it, Dr. Breathe Easy. First and foremost, I really appreciate bio putting this together, giving us a platform to really let our skill set shine. Of course, I did a lot of things on my own before meeting bio. We talked a little bit about that last webinar. If you guys want to hear more about my start and how I got into the business as a broker and eventually transitioned into an investor and now a syndicator, you can get into the last video. But this platform's been great, giving us a chance to really allow our skill sets to shine. Richard, who's over there, I message him all the time and gain insights from him. He's a really wizard with numbers. So just extracted a lot of value from the team, and I really appreciate it. Today, we want to talk about asset management. Last time we talked about how to acquire assets, especially in today's climate, which is proven to be challenging, right? You're seeing people across the industry say 16 to 20% below asking prices is where they're falling, just about every deal they see. And that could be difficult. You just bang your head against the wall, looking for a deal, and not being able to get anything to pencil. And what happens when you get one to pencil? What happens when you do strike a deal? You're able to raise the capital, you close. What's next? So asset management, that's where that comes in. And a lot of people don't really understand what that means, and they don't understand that it is a vital role in your business, whether you own 20 units or you own 20,000 units. Asset management matters. Most people just know about the property management side, but ultimately the property manager's job is just to keep your property full, collect all the money that you're owed, keep the bills paid, and give you reports. That's really it. So how do you as an investor get your goals and your KPIs achieved for yourself and for your investors? That's where asset management comes into play, right? So property managers, at the end of the day, let's just say your goal from your investors is to raise rent $100 per door, right, in the first year. But from a property management perspective, that may only mean $1,000 more per month for them. That may not move the needle for them. That may not be in their best interest to do, but it is your asset manager's job and their role to make sure your investors' KPIs that really drive things for your investor return are being delivered. So how do we do that? I wear a lot of hats in my business. I thought that, hey, look, I could be the investor, the owner, the property manager, the asset manager. I could do it all on my own. But at the end of the day, you can't, right? And if you want to do it that way, you can, but you won't get the most out of your investments by trying to do everything on your own, right? So joining bigger teams, joining bigger investing groups, spreading out those roles and responsibilities has been a game changer. I was actually a part of and I don't know if any of you guys saw this circulating on social media, but there was actually an asset management webinar going around yesterday. It's called Multifamily AP 360. I paid for the recording. I haven't had a chance to really watch it. Can I get a show of hands of anybody who was familiar with that or saw that in the chat box? We'll leave it open for a second. I'm just curious if anybody was familiar with that Multifamily AP 360 webinar that was going around yesterday. A lot of big time players were there. A lot of folks with big portfolios. Okay, Bio said he has it. I sent you the recording. You better check it out, Bio. Anybody else? It doesn't look like it. Okay.
I'm actually going to, in terms of reinforcing what you said. So yeah, if you want to go far, like you said, you have to go with a team, right? If you try to do it by yourself, even though you can get it done, you're not going to be able to scale, right? So that's what most people start with, right? So you're going to find out that you're spending more energy running an 8 unit or 4 units, whereas people that have 1,000 units spend less time and energy running that, and they make more money too. So it's a team game,
Right.
team sport we call it.
It is a team game. And just to set the stage even further, you guys, I know all of us hope to use real estate as our platform to replace our income, give us freedom, give us choices, give us just the ability to live our life free, right? That's the goal for all of us. And I don't think anybody would disagree with that. And real estate can become a job as well, right? You can have $10,000 of passive income and $5,000 of that. You don't hire a property manager, you don't hire an asset manager, you don't have a team, you're cash flowing $10,000 a month. If you really sit down with yourself and figure out your cost and your cost of your time, hey, how much are you really profiting? You may find out that you're really only cash flowing $2,000 a month because you could have had a property manager that you paid 7% fee to, right? You could have had an asset manager that you brought on your team to help you really dial into those KPIs that we look at on a weekly basis, right? Really sit down with yourself. Hey, is my real estate portfolio going to create freedom for me? Really break those numbers down. So let's just get into it. We don't have too much time. We try to keep these pretty brief. So I'll tell you guys some of the KPIs that I look at, right? And Bio had a great point when he said, hey, you may have a property manager that makes $15 an hour running your $10 million property. Is that wise, right? Running your entire investment. They're pulling all the reports, they're inputting data, they're leasing. You're not involved in the asset management, really pushing those KPIs that matter to your investors. What KPIs are we looking at, and what information are we taking back to the property management team to really drive the investments forward? One thing that I look at is unit vacancy detail, right? What are the current vacant units that we have? What are the upcoming vacant units that we have based on, and how do I look at upcoming vacant units? Who has a higher balance that may just skip on us? Is that a unit that may come available? In our leases, we actually require a 30-day notice before you move out. And that's the only way you even have a chance to get your deposit back. Most people who are responsible and expecting to get that money back, they've been taking care of their unit, their apartment home, they're going to give us a 30-day notice with the hope that they can get that deposit back. So upcoming vacant units, that's something I look at with that unit vacancy detail. And like I said already, who's giving us a notice? And then when they give us a notice, we want to know why. Why did they give us a notice? What can we do to maintain that resident? If they've been somebody paying on time, is that somebody we're just going to let leave? Are we going to try to retain that person? So these are things that we look at with that unit vacancy detail. Something that I look at very closely every single week is the gross income, gross potential income, GPI. That's the top line of your business versus my delinquency. So C-class assets, you're going to have a higher level of delinquency. And this is something that you definitely need to take your time with and really take a look at on a weekly basis. You can push it off on a monthly basis, but you can easily lose track and lose control. And once you lose control, it's hard to dial it back in. I would advise, depending on the class of your asset, maybe look at it on a weekly basis, maybe look at it on a monthly basis, that gross potential income versus delinquency. And the reason we look at that, are we collecting what's owed? Number one, right? Let's say you got $100,000 of gross income, gross potential income, you got a 90% occupancy, but you got a 10% bad debt or delinquency, right? You really are only 80% occupied technically. All right, how do we work on that? What do we go back to our property management team and say, hey, look, what can we do to get that 10% to maybe 2%? That 8% gap there can be hundreds of thousands of dollars of NOI that you're missing out on. Really taking your time with that and understanding that number can be a huge difference to your investors and your investment It also, if you let this get out of control, you can train your residents to think that they don't have to pay on time, right? You may find out that you have to put systems in place with your residents so you don't ruin the psychology of those folks, right? You don't spoil them to think that, hey, look, the 25th of the month, I could bring my rent and it's cool. They need to feel that pressure and they need to understand that, hey, look, that rent needs to be paid on time. So those are reasons that we're really looking at that. Why isn't the resident able to pay? Sometimes Bio, me, Rich, we sit on the calls on a weekly basis and we figure out, hey, look, why does this person have a late count of 5 since we've taken over the property, right? 5 months in a row they've been late. Can they afford to be here? Have they lost a job? Have them and their partner split and there's only one income rather than 2? Why is this happening? And we may be able to uncover something to where, hey, look, we need to put this person on a biweekly payment rather than a monthly payment. So these are things that I've learned with being in our group, just sitting down and masterminding with these guys and really dialing back. Because when you get your reports from your property management team, they don't tell you all this stuff. They just hand you 200 sheets of PDF forms, right? It's hard to really understand what's going on with the investment on a one-pager summary and then 200 documents. You have to really get through these forms, put it in Excel and really extract the data from it and really understand the story of the investment so we can report back to you guys. Next KPI that I look at is deliveries. We're in the value add space. Bio and Rich are actually in Kansas City right now, sitting down is it Madison at Overland? Is that the name of the investment, correct?
Yes, it is.
Okay. So
there's 200 unit townhome.
And we're going to leave a few minutes at the end so they can talk about what they saw there as well. And one thing that you're going to realize is, most of you may already know this, is that the only way that you can have a successful real estate investment is by adding value of some sort, right? Whether it's physical, whether it's on the operations, you have to figure out some way to add value. And a lot of times we're buying investments that we're going to have some kind of construction component, right? Whether it's as simple as going in and adding a technology package, or maybe it's something like the 129 units we bought in April, where we're sinking in about $9,000 per unit, right? Exterior and interior. There's going to be some level of construction on when we're rolling out these investments, and how quickly are they being delivered? Once we get a unit that's vacant, that's been worked on, how quick are we getting that unit back online? And that's something that prior to dealing with this group, when I was just doing investments on my own, I had hundreds of units on my own, right? I didn't know to look at all these things. I'm just, hey, get these units done as quickly as we can, but I'm not really tracking it, right? When those units become vacant, how long does it take to get back online? Because every month that unit is not online is actually a negative, right? You can get $1,000 a month from a unit, right? Let's say let's go back a little bit. Let's say you buy an investment and just give you the life cycle of a resident. You buy an investment and your plan is to raise the rent $300. The rent is $700 at acquisition. Your plan is to raise the rent to $1,000. The way you're going to do that is you're going to go in, add new appliances, new flooring, new paint. It's going to cost you $7,000 a unit. Just throwing a number out there. And you're vacant for 3 months after you're forcing people to move. You're like, hey, we're coming in, we're renovating units. Do you want to renew? If you don't want to renew, you can go. We're going to renovate the unit, put somebody new in. That's the plan, right? Your rent's $700, but it takes you 5 months to lease that unit. It takes you 5 months to renovate that unit and get somebody back in the unit. You've actually lost $3,500 with the hope of gaining $300 per month. It doesn't make any sense, right? I'm sure everybody can see what that can be, just a not so smart way to go about it. You're going in, you're forcing appreciation, you're forcing people to either decide to renew with you at a higher rate or move. You decide that the resident decides, hey, I'm going to move, and then you miss out 5 months of rent, which is $3,500. So you really need to track those deliveries to make sure that, hey, look, I'm not missing out on that gross income. Because that top line of your business, it really matters when you're doing these value add deals, because as you're going through your value add plan, you should still be cash flowing. And there's going to be situations where the plan doesn't go perfectly, but as the best that you can get control of these KPIs as an asset manager, the better off you'll be. Deliveries is huge. It's something that I've had to learn. I've learned the hard way. Even since my first investment that I ever did, which was 8 units, We bought it for 175,000, and I think we're going to put 227,000 into it, right? That investment just sold maybe a couple months ago for about 758,000. So I've been doing this since I was 25, 24, 25 years old. I'm 31 now, right? 6, 7 years. I know my age some of you may have thought I was a little bit older, but no, I'm 31 years old. I've been doing this since I was 25. And every investment I've ever done has all been some kind of physical value add. And just until recently, within the past 2 years, I've had to understand that the speed of your deliveries is really what drives those value add deals where you're going in and putting a lot of money into the units. The last thing that I look at, especially with the type of investments that I have, is turnaround time for open maintenance requests. I've done a lot of C class. I've done quite a bit B class as well. And we're starting to look at some A class stuff as well, just to really, as the market gets a little bit tighter, A class is starting to make a lot of sense, right? Builders and are needing to get out. They've overpromised with their investors and the people who finance their deals, and they're needing to cash out and pay off those loans. So I'm starting to look at A class as well. But the C class and B class space, something that you always have to worry about is maintenance, right? And how does that affect your residents that are in place? So how quickly can we serve our residents with our open maintenance requests? How long are those maintenance requests staying open? Are we getting, as soon as we get that maintenance request in, are they hearing from us within 24 hours? After they're hearing from us, how quickly can we get that maintenance request fixed? And are we getting a review for them after we get that maintenance request fixed? Those are things that I look at. And those are things that, like I said before, I've had to learn from experience. It's not enough to just, hey, look, I heard you. I understand your roof is leaking. All right, cool, great. They heard from you. Now what's happening? How quickly are you getting that open maintenance request closed? And then once you're successfully taking care of that person's need, are you getting a review from them? Tell us how great we did. Tell us how that frustrated you, how that inconvenienced you. And then you can figure out what to do better next time. And that shows that you really care about their experience. So it's not always about profit and loss. Sometimes it is about the resident experience, right? And that gets lost sometimes. That gets lost because this business is about serving our investors and getting a profit from what we're doing. But we also want to make sure that there's a people aspect as well. I see a question here. So with Celebrate, how many units are being renovated a month? How long are they taking to come online? That's a good question. Our goal was to do about 15 per month. Up to date, I think in September we did 11. No, September we did 11. As we get into these winter months, we got a chunk of units and we've added some teams. So we expect to do about 35 units. Bio and I talked about this before year end. We're gonna crank out 17 units a month, 2 months in a row. And we're gonna try to get those units filled quickly afterwards. How long are they taking to come online? That's a good question. So it really does depend, because some of these units have needed change orders. They're all in different condition with those C-class assets, but they usually take we should get about 11 units per month prior to this month. And it usually takes us about 3 to 4 days after that delivery to get back on our website. But to continue with this, are residents being communicated with while they await completion on their maintenance requests? That's something I look at as well. How are we communicating with folks? How do we document that communication? And are we sending regular communication to residents once they have an open maintenance request? Just to go back over the KPIs that I've had to really dial in on: unit vacancy detail, gross potential income versus delinquency, deliveries, and then turnaround time for open maintenance requests. Those are 4 KPIs that I feel are very vital when you're dealing with value in the value add space, and things that have helped me quite a bit really connect with that property management team and make sure the investors are being taken care of. I'll turn it back over to Bio. If you guys have any questions, please put it in the chat. We're happy to answer.
Wow. So thanks for that. I actually do have 5. We do have if you want a template, if you do asset management and you want a template we use, we have 25 questions we ask during our weekly meeting. So to reinforce, basically answer that question again about Southbrook, we actually are delivering maybe 10, maybe 11 per month. But we accelerated our evictions. So we really wanted to reach our goal faster because we're able to rent these units at the market rates. So we're going to take early paying, but faster operations. So then we evicted a lot of people. Most of these people are not paying. So now we have a lot of vacancy. So we're actually adding another team on top of the current team, or even double or triple team or two more. So at this point, we just basically told the team. So that's part of asset management. So you got to be, at one point, eventually you're going to give them enough chance that you'll be like, okay, guys, you guys have a contract, we need to move on. So you take a contract away from the construction team, or at least reduce it. So now they get to whatever they deliver, we keep working concurrently with other teams. So that's what you do. But that would get us to our like 1.5 year mark by 1 year if we're able to do all of this renovation faster. We were supposed to do them over 18 months, everything. So it would, so right now, if we really crank it up, we can do everything in 1 year. So yeah. And so I can go through some of the ones, and then you can give us what your input is, Josh, about some of the ones that we use. So we do have, so one of them is occupancy, which you already talked about. So the current occupancy, not only do you want the occupancy, you also want to look at the trend. When you do a value add, there's always like the deepest, like basically where is the lowest bottom. So once you hit it and then you start coming up, you want to stay up and then hit that back to 90% occupancy. But there will be a time where you're like going to be low occupancy and you should underwrite for that. Usually between delinquencies and occupancy, you always expect like 70, 75 during those turnover periods. But usually though, within 1 year, you should start moving up to the 80s. And by 18 months for sure, when it's time that you can potentially, because that's when you have the interest-only payment for us. So you want to make sure that you already have a good occupancy then. That is the main crux of success, in this kind of value add.
And if I may add one more point, just to the ability to look at your general construction crew or general contractor and evaluate the rate you're going and be willing to look at alternative options. Okay, hey, you guys are not meeting your expectation or obligations, so we have to pull in a secondary team to expedite our process for this. I think that's a vital piece as well, is being willing to look at your projection and look at the scale at which things are happening, and then being willing to pivot and make changes along the way.
That's a good point, Rich. And one thing I'll add to that is, hey, look, we do our initial underwriting. My role in this team is acquisition managers. I've had to up my level of underwriting to really understand, hey, what's my break-even occupancy on the front end? I know that most of our deals, our break-even occupancy on the deal is, we like to be around 70 to 75% occupied. So when our occupancy dips, hey, our internal team knows, hey, look, we're still break even. We stress test our deal. And we understand, hey, look, we need to make some adjustments to our business plan because that's what this is all about. You guys think that you're going to buy investment and then it's going to go exactly to plan of your initial underwriting. You are sadly mistaken. There will never be a deal that anyone ever rolls out, right? Now, they can give you distributions on time, but when you really peel back the 300 pages of reports that they're getting per month from their property manager, there's no way for it to go exactly to plan. But as an asset manager, you definitely want to keep a very keen eye on, hey, look, how can we get things on track? If we need to accelerate, we need to dial back a little bit, like Rich said, in order to get 18 months ahead at the 12-month mark, then that's what you need to do because that's what's best for the investment at that time. I think the construction piece on the value add deals is a very important piece. And that's why you see a lot of groups say, hey, look, we're bringing construction in-house because we need to be able to control that. We're bringing property management in-house. We need to be able to control that. And you really only think about that when you're a real asset manager because you realize that those are like the bottlenecks of your business. So I just wanted to add that. Continue, Bio.
Yeah, you're right about, and I always worry about one point of failure also. And if somebody wanted to add something, you can also chime in. One point of failure, right? If you have everything in-house, right? Then I'm always worried about, then if I fail, then everything fails. But of course, I do have team members, but that's just one thing. But yes, to have full control, I'm seeing this a lot. And that's another reason why we moved to B plus for now, because renovation at one point in time, the labor gets scarce after a while. So anyway.
And that's even more pronounced in this climate today, with unemployment being so low and labor, the cost of labor being so high due to the fact of that. So I think it's that piece, to Dr. Fasanya's point here, it's going to be based on season and the climate we're in terms of employment and being able to find resource from a personal standpoint to finish these projects.
So we look at the list, like you said, we actually do track web traffic. So for example, sometimes in some of our properties, we see 17 or 100 people check it out, click the link. Then why are they not applying? So you need to get an idea, or are you getting better traffic or not? We talk about closing ratio. So it's important, how many, basically the ratio of list closed to total application received. So are people really loving, this property or not? So that's something. So then we do have a specials, concession, and time frame, right? So every concession you make, it could help your bottom line or it could hurt your bottom line, right? So if you're not really getting good foot traffic, you might have to do a concession. Christmas bonus, Christmas lease, half of first month or something like that to ramp it up. Also depends on the time. Like, for example, we are gearing up for February right now. So February is when everybody get their tax. Most of the middle class, they file their tax return very quickly. That's when they get the returns, February, March. At that time is when they start looking, they're feeling rich and they want to look at some other properties, right? You want to be ready for that. You want to go all in your marketing. That's when you feel most, till the summer. February, March, April, May, June.
Let me chime in on that, Bio, if you don't mind. One of the things that I do behind the scenes is I actually connect with property managers in Arkansas, Oklahoma, Missouri. I talk to them on a weekly basis. Hey, what are you seeing out there? Right now, I've talked to 3 different property managers in 3 different markets. And around the same time, end of October, early November, they all told me, hey, we're in the slow season and there are people moving. They're more prone to move on you if you raise their rent and to find somewhere else. So you definitely, as an asset manager, you need to be making those phone calls. And it's hard for you to run a full-time job and also connect with property managers on a weekly basis. So you could bring those insights back to your property manager, right? And say, hey, look, this is what I'm seeing out there. This is what I'm hearing. Are you seeing the same thing? This is what my contact over here, this is what they told me that they're doing to overcome that slow leasing period, right? But at the end of the day, I started off as a broker, right? As a sales guy, there's always somebody transacting, right? There's always going to be people moving. Like Bio said, how do you draw those people to your asset? So if it's a concession, if it's a promotion, if it's a half off of your security deposit, if it's half your first month free, if it's a Visa gift card, if it's whatever you need to do during that leasing period where you're going to have that excuse of, hey, it's the slow period, right? Because our goals are our goals. If we got to lease 6 units a month, then we need to figure out how do we achieve that. We can't blame it on the slow season. If you got to roll something out to get people on your side, because it's going to be hard for me to believe that, hey, look, there's not 6 people in an entire market that are going to move this month. They're going to be in excess 10 times that in a market, people moving around. How are you going to draw those people to your asset? You got to position yourself well and not allow your property manager to make these generic excuses that, hey, look, it's the slow season, right? How do you draw those people who are going to be migrating and moving onto your side? And let us know, let us share our insights with that PM so that they can transact with us.
Yeah, that's true. So basically, it's a competition in the market. So you just have to figure it out. When it's a boom, it's boom for everyone. When it's a recession, it's a recession for everyone.
Everybody.
So when it's a boom, somebody raise rent. But you also have to be careful not to just do a race to the bottom. So just, you have to keep a balance. If your neighbor keep going down on the prices, at one point you just have to stop. So we talk about vacancy, delinquencies, evictions. So when you take over an asset, you don't know how much eviction you're going to do, because the contract that they have is different from the contract that you have. The way they screen their tenants is different from the way you screen your tenants. From everybody that we've gotten into our apartments, I don't even think anyone have left, right? So we've retained it. So because we have a better kind of screening process, right? We have a better screening process. However, you have people delinquent, not paying, and all these things. So you have to evict. And you try to make some plan with some people, but eventually, sometimes you just have to do it. And that happened a lot, that we evicted a lot of people. But you have to keep track, though. After a while, you want to keep track of what are the numbers, especially when you stabilize. It shouldn't be happening so often. If you have to continue to evict people after you recycled all the tenants in there, put all your new people in there, then you mean that you have to watch that, reconsider your screening process, essentially, because that means you're not really doing a good job. We talk about marketing. Josh, you can always pitch in Richard on this. I know we love Facebook Marketplace. Josh, love it.
That's the one, brother. I'm telling you, a lot of people want to get on all the paid advertisements. You have to as an asset manager, like right now, I'm going to be honest with you guys. I wasn't happy about certain things at some of my properties. I will post them myself on Marketplace, right? I'll do it myself. I'm not too good to do that. I will screen leads and literally send it to my team. I had a situation last week. Hey, leasing is slow. I sent them 5 leads in a week. I got on Facebook Marketplace myself, right? Like, you have to be willing to really get to some of those strategies that aren't fancy, right? You can pay for apartments.com subscriptions. You can pay for Zillow leads. You can do, AppFolio has which a lot of software, you ask your property manager what software they use. A lot of them use AppFolio. You could pay per lead. But once you get that lead, that's it. That's not going to determine the conversion ratio of that lead. At the end of the day, you got to have sales processes. And I'm sure these guys agree. You got to have sales processes to convert those leads. But why not use up all the free marketing you can? Get on Facebook. Every market you get into, they're going to have rental groups as well. So if you're investing in Tulsa, Oklahoma City, Tampa, Kansas City, wherever you are, just go look up some of those Facebook groups that are offering rentals, right? Like, you'll see a lot of these just open free groups that you can subscribe to, or your property manager can subscribe to. These groups already have 4, 5, 10, 20,000 members in these groups that are looking for rentals. Ask your property manager, are you a part of those groups? How do you do your Facebook marketing? Just free advertising. So that's something that I use a lot.
Yeah, hey, if it saves us money and we're getting people into the apartment complex, sign me up. I do love running ads on our self-storages. We also get new signage. You have something?
Yeah, and I think on the advertisement piece as well, one factor to keep in mind is that your strategy will have to change based on the market, right? If you're referencing renting to a Class C property tenant, Facebook Marketplace may be an ideal platform. However, if you have A or even a B or B plus, like what's here in Overton Park, you may have a different strategy from a marketing standpoint that could yield you a better return. So that piece, I think, is really contingent on the type of property, your client base, and the market as well.
I agree. Where are the people? The Class C people, they're on Facebook and different, trying to find a deal. Whereas Class A, if you're targeting technology people, physicians, the time is very limited, and sometimes you have to do a little bit more and also find to where they are. So yeah, good. We also always get a new signage. It's like one of call thing of mine. I was like, where is the sign? It's just nice to always have like a very nice new sign, that point people tell what are we doing over here.
Yeah, I think it's twofold on the sign. one, the previous owner, regardless of reputation in the community, the new sign really amplifies that the properties are new management. Even if it's the same sign, but just designed differently, it just amplifies that there's change that's positive, refresh, and oftentimes it's a low cost point compared to the ROI of what it often nets in return.
That's true. You probably spend maybe sometimes $500, but it changes the look, give people some hope, idea, and also actually does tell the people that there is apartment for rent here.
Mm-hmm.
Yeah. More points. Number 10, that's marketing. 11, we talk about innovations. You split it to interior, exterior, renewals. We talk about that. So you want to track your renewals. Josh, how do you get people to renew much better?
Number one, ask, right? A lot of property managers don't ask. They think that the renewals are, if somebody's there, if we keep it quiet enough, they won't move on us. But that's not true, right? Like your residents know when their leases are expiring. And a lot of property managers, they're not looking at renewals because, hey, look, if my occupancy is up, let's not rock the boat. But the last thing you want to do, and I learned this from Bio, he's, hey, you got 30 month-to-month leases. You got 30 people who can move out at any time. So first time it really clicked for me. Oh, wow. What if I had 30 people move on me within the next 2 months? How would that affect this investment? That would be catastrophic. Let's start sending out renewal offers, right? You can go, if you're, let's say you're going to renovate a unit and get $100 more, $150 more. Why not go to that resident that's in place and say, hey, look, this is our plan with the investment, but hey, look, if you sign this lease renewal for 6 months, we'll raise your rent $25 or $50. If you stay for a year, we'll do a $35. Give them a 6-month and a 12-month option and really let that person know, hey, we value you. We want you to stay, even though there's a lot of stuff going on around our property. We're improving, we're changing up some systems. We really appreciate you. Here's a 6 and a 12-month option. Which one works best for you? Email that lease over to them and then follow up. And then you want to track that on a monthly basis. We use Monday.com, which is the task management software. We actually input everybody into that software, and we have different columns that tracks their 6-month option, their 12-month option. Have we send that lease out to them, and where are they on that lease? Have they opened it? Have they not opened it? Have they signed it? And then moving them into a fully executed column where, hey, look, now they're off our month-to-month list. So it's very vital. You don't want to have that volatility in your investment with leases just outstanding. So for example, at Southbrook, we may have taken over almost 40 month-to-month leases. We're down to about 7 or 8, right? So that's something we really focused on, retaining the good ones, right? The ones that want to be there, that pay, right? And let's retain those folks and let's deliver them results as well. So that's something we track every single week. You're on mute, Bio.
We collect the renewal if data separately from the month-to-month leases, which is the same in terms of you want to make sure you're on top of your renewal before a month before they're ready to, the lease is expiring, you want to get on top of it. And then the month-to-month leases, yes, it's a pet peeve of mine. I do know that they're paying. Sometimes they're paying more. And so that's another argument, though, to Josh's point, when we discuss, I just don't say things. I mean, everybody brings their points. And his own point is sometimes the month-to-month leases are paying higher, right? So it will be, the rent will be like $800, but if you do month-to-month, you pay $900 or $850. And believe it or not, some people will stay there for 6 months or more, paying that higher price. But you just have to be ready, get that 1 month notice. It's possible that anytime they could move. I still think at least better, if not at least likely, that you get them on a lease. New hires, you want to keep track of your team. You want to be sure that you're running as lean as possible and also not too lean, because sometimes you do that and you find out your maintenance guy is only one person, and then there's now a mountain of requests that is not being done. Because as you're doing this renovation, you're also doing maintenance requests for people that are actually already in the apartment, right? So it's two separate issues. So sometimes you get too overwhelmed with the construction part of it, that I want, because that's the only thing I sing every day is I want units done and 1 unit rented. That's the only two things you can say that can make me happy. But then there's other part to it too. You have to make sure that, of course, because you're going to get the mass eviction. So when you hire new crew, we've downsized, we've hired more, so depending. We fired at least 2 people on Southbrook. So it depends. So you just have to continue to change and be fast about it because to turn the property around. And then we talk about CapEx spend. In this case, you want to know all your CapEx to date. You want to compare with your underwriting. You want to make sure that at least you're close to it. Yes, there will be some overrun. You're going to try, there will be some on both sides. There are a few things that we thought we're going to do. Then we're like, okay, maybe we'll hold up on that. There are things that are along the way that you'll be like, oh, we'll have predicted that. So that's the risk of Class C. And that's why you can make a lot more return on Class C. It's a little bit of slightly added risk versus the Class B plus property. Like Madison Overland Park, I mean, we drove there today. It's well maintained. It looks nice. If you go on YouTube, you can see our failed Facebook Live, but you can still see the property. So, and you can see that there's not going to be a lot of CapEx, you know. There's not much. You just clean up. It's not the deep renovation at all.
It's all cosmetic, landscaping, playgrounds, dog park, picnic areas. It's all cosmetic stuff, yeah.
So yeah, so Pastor Sabro, we're going all the way. And it's in our community, and we absolutely want to change some of the perception. And we're getting paid for it. Some of the rents are like $500 when we took it over. So what's the rent now that we're getting, Josh?
Yeah, on our 1 bedrooms today, when we took over, their 2 bedrooms were getting $600. Our 1 bedrooms are getting $600. Our 2-bed 1 baths are getting $725. 2-bed 2 baths $775, and 3-bed 2 baths at $850. Right, so we bumped that rent up in some of those unit types. Like Bio said before, we were getting some lease renewals that were going up on their rent $100, $90, $80. Right, let alone the renovated product where we haven't had one person who's moved into one of our renovated units move out yet. All right, so we're delivering a quality product, and that's the beauty about real estate, right? We get to change people's lives, not only our investors, but the people in the community forever, right? This property's been needing to be touched for years. We go in, we do our value add program, and I drive up to the property and people are stopping me in my truck. Hey, I want to thank you because you've changed the way that I live my daily life. This is amazing. Thank you. We appreciate it. So it's way more than just bricks and sticks. It's about changing people's lives along the way and driving a profit. So we're having a lot of fun. And Madison Overland Park, we only got a few more minutes. Do you want to talk a little bit about what you saw today and the...
Yeah, absolutely. Absolutely. Just for those of you guys who are not aware, this is a 200 unit community townhomes in a very progressive and highly sought of part of Madison and the Kansas area of Missouri. Dr. Fasanya and I went by today and got a pretty decent tour of both their model units, 2 and 3 bedroom units, as well as their campus, the entire community. They're in impeccable shape. Of course, it was fall, so there's a few leaves just blowing around, but overall, we also did maybe a 3-mile radius drive around this community, and we couldn't find a single family resident for sale. That's the kind of market it's in. So it's a great property with incredible potential. One of the mass advantage for us here is that this is a loan assumption at just south of 4%, which is 3.9%. Thank you, which is unheard of or unavailable in any traditional banking setting today. I mean, you'll be lucky if you get 8.5% to 8.25% today. So the property itself is great. They're essentially 3-level townhomes, a basement with washer and dryer and some kind of living space, so to speak. The main floor, which is where all of the kitchen, dining, living area is, and then of course bedrooms upstairs, all with 2, 3, or 2.5 bath. Great community, great opportunity, and a great way for our team to continue to be good stewards to residents in different areas and help them live a more stable life in as a tenant, so to speak, versus a homeowner.
Yeah, the cost to own is very expensive in this area because it's a number one school district. So nobody's going to live there. When the kids finish school, perhaps, but then their kids, grandkids are going to start school. So basically, you're stuck in this neighborhood. And if you don't have the money, you rent. And also, if you like live this millennial kind of Gen Z lifestyle, newer generation, so they are not buyers most of the time. They just want to move around a lot, and they find this place to be okay. I'm going to be here for 6 years. Around.
Yeah.
So.
And I think it really shows as well, if I want to remark, I think it really shows that it's a community because of the number, and that's family focused actually, because of the number of playgrounds and dog parks and picnic area that weren't just idle space, that they were actually being utilized by members who live here. And I know it's Saturday morning, so it makes sense, but I was promising for sure to see how comfortable the residents are who are here, so much so they're utilizing the amenities that's available to them on site.
So a bunch of dogs, people playing around today. Yeah. So it's good. And the good thing is it's actually oversubscribed. So we're actually not marketing it. But we're just showing you what we're doing, what we're up to. There's going to be another new construction deal coming up. And we're going to be talking more about that soon. Josh is going to be helping us package that together. And there's also a business we're going to be talking about for partnership at some point. So, yeah, thanks for coming, Josh. And also, I forgot to mention my co-host, Dr. Ozoude, is actually in a flight. He got caught up in a flight. He won't be landing till 8 o'clock, he said. So I had to host by myself, but it wasn't too bad. I have Richard, I have Josh, so all the members of the team. So thank you everyone for coming also. I know you have a lot of great stuff to do on your Saturday evening. And so thanks for coming. Anything else to add, Richard?
No, I think that's it on my end at least.
Hey, no, I appreciate you guys logging in from Kansas City, giving us the play-by-play today at Madison Overline Park. We got a lot of good stuff coming, a lot of big plans for 2024 and the end of 2023. So just it's always a blessing to be here, share what we're learning. We're not coming from a place of know-it-all. These are the things we've had to learn based on just mistakes and trial and error. So we really appreciate you guys, and we'll see you guys. When's the next webinar, Bio?
It's 2 weeks. Every 2 weeks, 4 p.m. on a Saturday.
All right.
On Central Time. Unless we have a deal, then we do a webinar in between.
Perfect. We'll see you guys in 2 weeks. We really appreciate you guys logging in this Saturday. Thank you.
Thank you all. Have a good evening.